Alright, so I wanted to shoot a short video today just to showing you what to do on 18.4 and 18.5. I'm on 18.4 working together. If you take a look and just read this, it says on July 6th, actually for the first step it says for each of the following transactions completed in year 4, it says 20-20x4, so it's year 4, journalize an entry for additional depreciation if needed. Okay, that means if we were to sell this halfway through the year, we can depreciate those months before we sold it. Again, this is all pure tax dollars. We're just trying to save money on taxes. Okay, so that's why you would depreciate half a year or a third of a year, or even 1 month. That's why you would depreciate it out. Okay. Okay. So on January 6th, we received cash for sales of a computer monitor, plan asset number 241. Okay. So we received cash from sales. So we're down here on number 2. Number 1 we're going to do here later on. But this is number 2. So it said that it was plan asset 241. Okay, so here's our plan asset sheet. Okay, this is our record number 241. If you can see up here, I apologize for this bright light here. There's really no other way about this that we can do it. But look at 241. This is computer monitor. This is what we're going to be selling. So this is as far as you should be right here. Okay, so first things first is the information said that on January 6th, we're going to sell the computer monitor for $290, R4. Okay, so right here, make sure you put $290, and then we sold it. We didn't discard it. We didn't trade it. We sold it. Okay, so $290, and we sold it on January 6th. Okay, they always use 20-4, just saying it was year 4. You would put the specific date on it if your actual business, but right now we're going to do everything with just X4. You can even leave off the 20 if you want. Just X4. That just means year 4. Okay. So this information right here, you can see when we sold it. It was January, so there's no additional depreciation during the year. We're going to sell it right away. So our accumulated depreciation is $300. That's going to be important. We'll come back to that. Okay. So the first thing I would like you to do, okay, going back to 18.4. The first thing I would like you to do is take a look at what we sold it for. So the amount was $290. So you're immediately going to go to cash. And I want you to put $290 in the cash. Okay. The second thing you need to do is figure out how much depreciation there was. Okay. So I'm going to step right here and I'm going to write January 6th. I'm going to abbreviate this. Accumulated depreciation, store equipment. Well, how do you know it's store equipment? Okay, if you go back to 18.3, on here you would have wrote what it was. Okay, it was store equipment. That's how you would know that. Okay, so going back to 18.4 here, try to line this up. Okay, so the accumulated depreciation was $300. Forgot to show you that when I was here. That's this amount. I'll put it up above. Accumulated depreciation was $300. Okay. So we're going to write accumulated depreciation $300. Okay. You're also going to look at what you bought the item for. Okay. So again, on 18.3, if we look here. We bought it for $560. Okay, so all this goes back to our plan asset record on 18.3 on page 545 in the book, and page 33 in your workbook. Okay, so again, $560 is what we bought it for. Accumulated depreciation is $300. Line that back up for you. Okay, so the next line is going to be store equipment. Okay, again, this is what we bought it for, so you need to write $560 here in the credit. We are getting rid of it. An asset always has debit balances. We are getting rid of it. We sold it, so therefore we need to take it off our books. You need to put $560 in the credit. Okay, we depreciated it $300. Okay, and we sold it for $290. So now we have two options left. Did we make money on the sale or did we lose money on the sale? Okay, so this is going to be either a gain or a loss. what you need to do is you need to add up your debits and credits. So your debit is $300. Your debit over here is $290. So that's $590. Okay, we'll write that up here. Okay, we bought it for $560. So we gained $30 on this transaction after we depreciated out. We have to pay taxes on that money. We have to record whether we gained money or lost money on the sale. Okay, so now we're going to go ahead and put in gain on plan asset. Okay, forgot to put my documentation there. It was R4. Gain on plan asset of $30. Our credits equal each other. Our debits equal each other. We now just finished that first transaction. Okay. The second transaction was on July 12th. Again, this is July 12th, so this happened halfway through the year. Okay, so we're going to have to depreciate some. Receive cash on a sale from a notebook computer. Plan asset number 42. Okay. So again, the first thing you need to do is you need to figure out what you sold it for. Okay. We sold it for $325. So again, go to your cash credit. $325. Okay. The next thing you need to figure out is your accumulated depreciation. I was looking at the on your own. I apologize. The number is actually $800. Okay, the number is actually $800 that we sold it for. Again, I was looking at the on your own, not the working together. So we sold it for $800. It was plan asset number 42. It was a notebook computer. Okay, so I need to take that information off. I need to put this information back up there. We're looking at the second plan asset. That should help. Okay, so we're looking at the second plan asset here. Notebook computer. Office equipment is what the account's going to be. We sold it on July 12th, okay, of year 4. Okay, so year 4, July 12th. We cannot use this accumulated depreciation of $1,600 because that's after the full year. We bought it on October 19th, so we need to figure out how many days we're going to depreciate it. Okay, so if this is October 19th, that'd be your partial year. We need to go from January to full June, so 6 months. Okay. So if we're depreciating $50 a month, remember we go back to that formula where we take original cost minus estimated salvage value divided by useful years. In this case, we divided it by 4. Okay, we got $600 a year. Okay, we need to divide by 12 to figure out how much monthly. That's $50 a month. Okay, so we have for 6 months we need to depreciate it for January, February, March, April, May, and June. We sold it on July 12th, so we can't depreciate it for July. So for 6 months, that's an extra $300. You cut this in half. So we need to depreciate it $300 on year 4. It looks like that's all we could. Oh, you won't have this done yet. We need to finish this later on. Okay, this is 18.4 right here. That's why we figured that out. Just for 3 months there. Okay, $1,600. Okay, and that's your total amount. So $1,600 is the total amount. Okay, you need to mark here that we sold it for $800. Okay, on July 12th. On 24. Okay, we sold it for we can depreciate it $300 more. $1,600 is the number we need. I got students coming in here for study hall, so I'm going to finish this. Okay. So if I come back here, okay, again we're going to be accumulated depreciation office. Okay, office equipment is going to be the next one. Okay, remember the accumulated depreciation was $1,600. Okay, we sold it for $800. Okay, we bought the equipment for $2,775. Okay, so technically, we need to figure out how we did here, okay? So do your math on it. When you do your math, debits and credits, you'll see that we are short $350. So we actually have a loss on plan asset.
Oh, man, sir.
Look at that.
Okay? So when you add your debits and credits up, we are short $350. So therefore, we lost that amount of money. We can write that off on taxes. Technically, these two lines should be switched around, but I'm not going to teach you that way because you have to figure it out before you do it. It's much easier if you find your numbers, then figure out if you gain or loss. So I will accept it this way. Again, the date was July 12th. And that's how you would do 18.4, okay? If you have any questions, stop in, you can ask, but that should help. Okay, to finish this up, what I want to show you, since we depreciated halfway through the year, we need to record all that. So as I go back and we take a look at our plan assets here. Okay, you guys can see here, move this up, that you have to finish this out. These are the answers. You need to put 24, 300 because we can depreciate it half a year. We sold it on July 12th, so January through June we can depreciate it at $50 a month. We're at 300. The total is 1,600. Okay, ending book value was 1,150. Mark that out. Now we need to also record that in the journal. Okay. So I need to move this. I'll keep this information up here. In our journal, we need to record that depreciation. Normally we do it at the end of the year, but since we sold it halfway through the year, we need to make sure we record it. So again, it was on July 12th. It was depreciation expense, office equipment, and it would be accumulated depreciation. Okay, the memorandum was M67, and it was for $300 again, half a year. 300 debit, 300 credit. Again, we had to do that because we sold it halfway through the year. Okay, so you really have to pay attention to the dates when you bought it and when you sold it. And again, we depreciate because it helps us out on taxes. Okay. All right, next one. Double declining method. We're going to do 18.5. Okay, 18.5, let's quickly go over this. This is double declining method. One of them is to just record more depreciation in year 1 and 2, help you out with tax purposes. This one you're definitely going to have a lot more. Okay, this is how you're going to figure it out. If you take a look on page 18.5, we bought it on January 4, a truck. Original cost was $22,000. Okay. Okay, so our plan asset is a truck. Our depreciation method is double declining. It's actually called double declining balance. I abbreviated it there. The original cost is $22,000. The salvage value was $2,200. Okay, and estimated useful life is 4 years. All right, so the way you do double declining method is you take your 100%. Okay, I'll just write it right here. 100%, you divide it by how many useful years you have. This is 4. So 4 divided by 100, or 100 divided by 4, equals 25. So it's a double declining, you double it. Times 2. So each year, we're going to depreciate it 50%. That's how we come up with that. Again, 100, always 100. Useful years, this will change, okay? If this was 5, your answer would be 20 times 2, and you depreciate it 40% a year, okay? But it's not. It's 4 years. Okay, so we divide it by 4, you get 25 times 2, 50% a year. Okay, so year 1, The beginning book value was $22,000. Our double declining rate was 50%. Okay, our annual depreciation should be simple math. Don't need a calculator. Okay, is $11,000. Again, this just allows you to write more off on taxes. Okay, that's why you use a double declining method. Okay, we write $11,000 off. Our ending book value is $11,000. Okay, year 2. %. Okay, so 5,500. Ending book value is 5,500. Okay, we're just cutting it in half every year. You have to be careful towards the end because we're going to run out. A lot of students will want to just keep going. Okay, 5,500 at the beginning. Still 50%. Okay, so 2,750. 2,750. This is where it gets confusing because year 4 you can't just go 50% again. Okay, if we did 50%, it would be a lot more. But remember, our estimated salvage value is $2,200. You got to keep that in mind. Okay, so we can't go below that. So we're going to take 2,750 minus 2,200. Okay, you're going to get $550. That's all we can depreciate it left. If we did the math, it'd be a lot more. Okay, it'd be over 1,000, but we can only do 550 because that's all we have left. You can't go below the estimated salvage value on that last year. Okay, so we still say 50% even though it's not, and we just do what's left. 5,500. I'm sorry, $550, and we get to our estimated salvage value of 2,200. Okay. That's double declining. You got 2 more to do on working together. If you have any questions, stop in and ask. Thanks.